Hi there, my name is Kevin Austin and I'm the Technical Director at Access Financial Group. International contracting can be exciting, but navigating another country's tax and legal landscape can be complex. This video guide outlines key considerations for using your limited company to work abroad. These points apply to any company you may be using abroad for contracting. Tax residency. Your residency status determines where you pay income tax. Double taxation treaties often exist to avoid paying twice, but understanding residency is crucial. In many countries that have double tax agreements, DTAs, with your home country, the DTA sets out where you will pay your taxes. There are two main aspects of residency you have to bear in mind. In particular, we're looking at income tax and corporation tax. The income tax treatment will depend on whether you're a dependent or an independent worker, or more usually employed or self-employed person. In general, but not always, self-employed people pay local income tax from day one of their stay abroad. Typically, employed people staying less than 182 days pay tax back home. However, if the stay is for longer, then local income tax is payable back to the start of the assignment. The other crucial impact of residency is with work countries that have worldwide taxing rules, including the UK and Germany, but most advanced economies. Residence here establishes that your worldwide income is taxable and not just the income arising in the work country. In these cases, the DTAs exist to avoid income tax being charged twice on the same income. So the points you must bear in mind are, am I an independent or dependent worker under the DTA? And is my stay long enough to tax me as either? Is my stay long enough to bring my worldwide income into the tax net of the work country? To find the answers, you must consult the double tax agreement between your home state and the state where you're temporarily working. Now, regarding the corporation tax treatment, we need to consider and look at permanent establishments. So what is a permanent establishment? Under the double tax agreement, relevant to your individual circumstances, there will be a definition of a permanent establishment. This is commonly a fixed place of business, which can be, for example, an office or a warehouse or a regular location where business is carried out. The definition may also set out what is not a fixed place of business. That said, many jurisdictions look closely at where the seat of management and control resides. If your company has only one director and that director has shifted to the work country, then it's easy to see how the tax authority may determine that the company's management and control has shifted from its ordinary seat of residence to the work country. There are two main outcomes that flow from this event. The implications of a PE on corporate profit tax. The first is that companies are typically taxed on the corporate incomes for their corporation tax based on where the central management is. If you shift the central management control, it follows your company can become liable to corporation tax on its profits generated in that other state, while it's deemed to be resident there. You'll likely pay home corporation tax on your limited company profits. Profits from overseas work have specific implications. You have to refer to the double tax agreement, the DTA, for set-off. The implications of a PE for VAT purposes. The second implication is that the company may exceed the threshold for VAT registration in the work country and may have to register. Thresholds vary widely. In the UK, it is £90,000 in a 12-month period. Within the EU, for inter-EU B2B, the threshold can be as low as €10,000. Social Security. Will you contribute to your home country, the work country, or potentially both? Depending on social security agreements, A1 certificates or certificates of coverage, they may be applicable. So typically, you pay social costs, or as they're known in the UK, national insurance contributions, in the country where you work. Supposing you're working in more than one country, you could potentially pay social security costs in more than one country. And this leads to obvious complexity and confusion as to where you'll draw social benefits. In a similar way to double tax agreements, states have agreed what are called social security treaties, or sometimes totalization treaties, to solve this problem. The EU has agreed Europe-wide social security treaties, but not DTAs, that specify that it's possible to contribute in one state alone. Typically, the state where you're ordinarily resident will issue you on application with a certificate of coverage known in the EU as an A1. An A1 can exempt a worker for up to 24 months from having to pay social charges in the work country, provided you pay them back home. They're not a free ticket to pay no social charges. In the unusual case, where you work simultaneously in more than 2 EEA states, then you may obtain an A1 from where your employer is located. What is a foreign employer? If your company employs you to work abroad, your company is now a foreign employer, or FE. Wherever it's possible to be an FE, you must register as such and operate a payroll subject to the rules that prevail in the work country. In some cases, it may be possible to pass these responsibilities to your employee or director, but then they must observe the regulations to ensure that they pay the correct taxes and social charges. We highly recommend a tax advisor specializing in international business to navigate these complexities and ensure compliance in both countries. They can advise you on tax residency, determining your residency status, double tax treaties, understanding their impact on your tax obligations, permanent establishment, assessing if your limited company creates taxable presence in the work country, transfer pricing. These are the rules governing how you charge your limited company for services. And Social Security, determining your Social Security obligations. On VAT registration, you've got to understand the thresholds and requirements. Now, coming to business operations, business registrations and licenses. You must check if your limited company needs legal registration in the work country, or it may need specific licenses or permits required depending on the industry that you're in. Employment and visa requirements. Work visas might be necessary, and you must explore the visa options based on your situation. Employment law compliance. You must ensure adherence to local employment laws regarding minimum wage, working hours, and employee benefits, and this applies even if you are the sole director of your company. Financial considerations. International banking. You should research the banking options for your limited company in the work country, including the currency exchange fees. Currency fluctuations. You should manage the potential impact of currency fluctuations on your income and expenses. Accounting and reporting, separate accounts. Now, depending on the work country's regulations, you might need separate accounts for overseas income. If you don't, you may have to share and explain all your income and expenditure to the local tax authorities. Tax reporting. You need to understand the tax filing requirements in your home and work countries. There are strict reporting requirements and timings imposed by all the tax authorities, and failing to meet them can lead to penalties and fines. Risk management. Local representation. You should consider appointing a regional representative to handle the administrative tasks or legal issues. Flying under the radar cannot be relied upon. If you're not familiar with local rules applying to directors in their foreign companies, our advice is to consider other options. Insurance. You must explore the relevant insurance options to protect your business from risks in the work country. In most jurisdictions, there are mandatory requirements for companies operating there, and these may include pension insurances, public liability, and employment insurance. It's very important to establish what you need and arrange cover, or you face potentially large penalties. Using a foreign limited company, or any limited company to work abroad, is not straightforward, and you should assess the pros and cons compared with a simpler employed or self-employed solution. However, if you are a professional contractor and your contracting is genuinely a business rather than a series of short employments, then it has its rewards, but you need to be aware of the implications. Working through a foreign company, expecting to avoid local income tax on yourself, social security charges on you and your company, without any VAT implications, without corporation tax implications, and the panoply of licenses and insurances needed to operate is likely to end badly. And our advice is to come to speak with our accounting experts at Access Financial that specializes in this area and has done this since 2003. In the video description, you'll find our contacts and you can schedule a free consultation with our experts. Please subscribe to our channel and stay up to date with the latest news, and leave your comments with questions and suggestions for upcoming videos. Thank you.